Hello, I'm Stephen Hode, technical analyst, trader and founder of The Stop Hunter. Now, are you guys looking for that elusive trading edge? Are you open to learning new ideas and concepts to use technical analysis? Well, I might have something for you here in this course. It's all about Kagi, and Kagi are an ancient Japanese charting method that I first discovered when I was working for a Japanese investment bank back in the 1990s, and I've loved using them ever since. I found them a very powerful charting tool and a different angle against using all the other types of technical analysis chart types. Very powerful, very effective, and like I said, I take you from start to finish in this course, and by the end of it you should be able to apply it to your trading. All I ask for as payment for this totally free course is that you like and subscribe to the channel, and if you've got any feedback, let's hope it's positive, please leave that as well in those comments below. So with all that and without any further ado, let's get into it. So quickly covering off the course content, we've got 5 sections, 31 lectures, almost 3.5 hours of video content. We've got 5 sections. Section 1 is the introduction. Section 2, what are Kagi charts? That covers things like brokers, technical analysis, packages, Kagi's relationship to other chart types, basic constructions of the charts, the yin and yang lines, why time and price are important, my approach to setting up the Kagi lines, further exercising using Kagi, useful chart patterns, and then we move on to section 3, which is about strengthening the predictive nature of your Kagi charts, and in there we learn to add Western indicators, things like trends, moving averages, bands, awesome oscillators, the DMI, even Ichimoku again from Japan, and some exercises, a simple strategy in how you would apply risk and trade management to your Kagi charts. Then we learn in section 4 how to get into the trading of Kagi. So that's about creating strategies, firming up entry and exit rules, and rules for running those strategies and how you put it all together. And I'll give you some other ideas of how you can use Kagi charts in conjunction with other chart types and strategies you may have, and we briefly touch on algos and automation. And then section 5, the Kagi course roundup, where we sort of summarize what's gone on and the next steps for you to follow. So as Bobby Axelrod says, let's go to it and it will be fun. So let's crack on and dive first into section 1. Now the Kagi chart, the technical analysis type of chart, you may have or may not have heard of. It sounds quite mystical. It actually comes from Japan, and if you've ever seen it, it looks quite strange and weird in comparison to other charts that you might be previously used to. But once you get to know it, it's a great chart type for trading and to give you that all important trading edge. It has many benefits. It can be used in any market. There are no time frames, so you can speed it up or slow it down by price to suit your trading strategy, style, lifestyle. It will take out a lot of the noise of your trading and help you with discipline, consistency, and that all elusive trading psychology. And in terms of trading, it's great for day trading, longer term trading, reversals, trending, swing trading. It captures all possibilities. And once you understand how to set the yin and yang lines, how to apply and use other indicators on the Kagi chart, then you're all set to create your own strategies and use it in your own trading. So let's take a look at some examples. So here is a standard Kagi chart on the S&P 500 US stock market index, and from first look, well, we can instantly see that it certainly looks different. So let's have a quick comparison to the equivalent, say, stock standard chart that you probably use. On the left we have our Kagi chart, again on the S&P 500, and on the right we've got a candlestick chart. Same period of time, but look how the Kagi chart gets rid of all that noise and simplifies the whole analytical process. And this is one of its super strengths, is how easier it makes your analysis and trading, and because of that it produces a more disciplined, consistent approach. Now here we have the Nikkei 225. It's a Japanese stock market index, and I've added an indicator below the chart, and I've drawn on trend lines and added a moving average and put on some of the terminology that we'll look at that is unique to the Kagi chart. But you can see, because of the simplification of the data, trades like breakouts are more obvious. We can find support and resistance areas more easily, and you'll get to learn that the red and the black lines mean something, and in this example here the blacks mean it's a buy opportunity, the reds a sell, and we learn how to interpret those. So again, the trading psychology and consistency and discipline is made a lot easier. We marry that up to Western techniques that we can now apply on top of these type of charts due to advancements in technology. We can then create powerful, consistent trading strategies that you will be able to easily apply to your trading. So what will you learn on this course? Well, you're going to gain a complete working understanding of Kagi charts. You're going to learn why Kagi charts and charting can be a very effective tool for your trading, and learn how to apply Kagi charts across markets and these subjective time frames that we are going to look into, and learn how to adapt and strengthen the original Kagi concept for your own trading, and learn how to use Kagi to create powerful trading strategies. So who is the course for? It's actually for anyone from beginners through to advanced, but it's great if you have some prior knowledge of trading and technical analysis. It helps, but it's not essential. You'll get all you need to know from within the course. So it's for anybody really interested in learning a new approach to trading, and those looking to get that edge in their trading, and it can be, like I previously mentioned, used across all markets, whether that's forex, indices, stocks, commodities, and for those that trade CFDs, futures, options, spread betting or spot markets. Now the course format is modular, and it's broken down into easily digestible sections, and it's a combination of screencast and slide presentation, and supplemented with further working exercises to build your knowledge of the subject. And I support the course through myself and the Stop Hunter team to help you work your way through the course, and we will discuss more of those resources within the course itself, and moving on mostly to the important part of what you need for the course. What resources? Well, firstly, obviously, a good PC and internet, and secondly, a broker to execute these trades, obviously, and a charting package that allows you to create Kagi charts, and that's very important for this course. You might have your own, but again, within the course I can guide you into finding you the appropriate charting software, but we'll discuss all that and more in section 2. Some important housekeeping to go through before we continue. You may see some symbols pop up every now and again throughout the course. They all have a meeting and all should be taken an interest in. The first one, warning sign, that's for obvious purposes. It's a standout. Do something about it. It's an action. I'm warning you. The magnifying glass, a concept check. The microphone, it's an important topic that you need to pay attention to. The workbook is an exercise, something for you to get involved with and practice with, and the light bulb is a tip. In regards exercises, you're going to find them at the end of most of the lectures or as standout lectures on their own. So like I say, look out for that book symbol. Now if you need a technical analysis charting package, which is pretty essential for the course, you may already have your own, but if you haven't, then I thoroughly recommend TradingView. It's a lot more detail on my website, and there's links for how to sign up there. That's www.thestophunter.co.uk, and go to the Our Charts page to find out all that detail. And for brokers, you might need a broker to do your trading. You might be just starting trading. You want to open a demo account, whether you're in the UK, USA, or anywhere in the world. If you're trading spot markets, CFD, spread betting, etc., etc., then again, please visit my website for who I'm using to do my trading and who I recommend you use. Again, www.thestophunter.co.uk, and visit the Our Brokers page. So that's all the housekeeping covered. It's now time to crack on with the course. Now there are many types of different chart and technical analysis, and I specialise in the Japanese variants, Renko, Kagi, Line Break, Aikanashi, Ichimoku for example. But for our first look into Kagi, I want to draw a comparison to the other Japanese chart types, so you can start to get a feeling for the difference that Kagi brings to the trading situation, and also just a quick look at how it compares to a standard candlestick chart. So you may or may not be familiar with these Japanese chart types. We've got line break on the left, Renko on the right, and in the middle we've got our Kagi chart. Now all three of these are set over the same period of price movement data, and you can see that they all give a slightly different answer once they're set up. And this is good for us because it creates different opportunities, different edges by using these different types of chart. And you can see in the Kagi in the middle looks completely different to the line break on the left and the Renko on the right. Now I've used Amazon Inc., the American mega corporation, to compare those different types, but to really see the true value of the Kagi chart, we can compare it back to the standard candlestick chart to see its true value. Again, Amazon Inc. Uses the comparison. On the left a candlestick chart, on the right the Kagi chart, same again period of price data. Look at the noise on the left, very difficult to translate, and look how simplified and easy to analyze the trends, the movement in prices by looking at the Kagi chart. Very quick to ascertain what situation you're in currently, very quick, easy to make decisions from. That equals discipline and consistency, all the things we're looking for in our trading. So after that first brief look at Kagi, we're now going to move on to how to create the Kagi chart, the basics behind it, a bit of history. But before that, there's an exercise for you to do. When you get to the exercise in the video, just pause it, play through the questions, record your results, and then move on to the next section. I think you've guessed by now that they were created in Japan, the Kagi chart. They've been around since the late 1800s, so they're one of the oldest chart types around, and they were created, like many other Japanese chart types, to give transparency to analysis of markets that they were looking at, in particular like rice markets. And another of its unique features is that it ignores time. It is just looking for the movement in price, and that creates the unusual chart looking setup of different coloured or thickness of lines. The Kagi chart actually derives its name from the old Japanese style of L-shaped key, and because of this, in Japan the Kagi chart may also be referred to, or you might also hear it as the key chart. So now let's get into the nuts and bolts of the Kagi chart construction. So what you've been most used to in your technical analysis and trading is using charts, traditional popular charts like bar, line, candlestick, that have a uniform date axis, equally spaced days, periods of time, minutes, etc. And the analysis is based around one data point in whatever time period that might be. So let's just cement that idea in our heads first by looking at an example. Here's our standard candlestick chart, time on the x-axis and price on the y-axis, and if we zoom in we can see that one data point is created because of this combination of time and price, which then allows us to create these one data points that we draw some analysis from. But this is very different in the world of Kagi charting. Kagi charts are very different. It's the study of the pure price movement. If we take it back to its raw rules, then it only involves price movement. It doesn't have time. So when price moves, it creates a new variant of its line, and these lines are known as the Yin and Yang lines, and they measure the price, and the lines change direction once the price moves a set amount that you have created. So this is purely a chart that looks at market price action, although, as we'll come to see with modern charting technology, time does play a part. So this really is important. You must remember that Kagi charts are all about price action and its movement, not how long it took to get there. Some key introductory terminology you're going to need to know, and Kagi does have its own language, so you're going to have to get used to it. The Yin and Yang lines, normally it's a black line to indicate bullish periods and a red line to signify bearish periods. Now if we go back to the original charts, you would have one colour, black being the bullish and thicker line, and bearish being a thinner black line. And you'll see a horizontal line. This is called the inflection line. This is when the price reverses into the other direction, and there are a lot of other words and phrases in price patterns, but we're going to look at them in later sections. So here's an example on copper futures for you to digest. See the horizontal lines, they're the inflection lines, the turning point of the price, whether it's going from bullish to bearish or bearish to bullish. And here I've set up red as bearish and black as bullish lines, and these are our Yin and Yang lines. And for the moment, really that's all we need to know. I'm not going to be using thick and thin lines. Most charting packages these days provide two colours rather than working on thick and thin, but if you prefer that and your chart package allows you to do that, there's nothing wrong with doing that. So now let's work through a hypothetical example. Here I've created a series of data for WTI crude oil, and what we want to do is see how the Kagi line evolves over a set of price data, and the nuances behind how the lines are created, and from that hopefully you'll get a better idea of how to construct and use the Kagi chart. So we need a base price to start our chart from, but even before that we need to create something called a turnaround reversal amount. In this example I'm going to use $1. So that means when the price moves more than $1, the Yin and Yang lines, the bullish and bearish lines, can possibly change in terms of direction. So in our example, the starting point is $29 because that's our base price, and it actually closed at $31.50. So with the Kagi chart you get three choices. You can draw an up, down or no move in terms of the line creation, but here we got a $2.50 up move. It's moved more than the $1 turnaround amount, so we create a new thick up line, and that's drawn to that closing price of $31.50 as we can see in the illustration there. Now on day 2 the price was up further to $32.97, and that was enough to create a further line extension. It was still in the same direction to the prior movement, so all we do quite simply is just extend that line up further. Then what happens is we get a big down move, so going against the trend. So what happens next? Well, that $3.74 move was actually greater than the $1 turnaround point, so we create we move to a new down line, and that's where the inflection line gets drawn at the top of that high, and then that creates the new down line. So we draw that all the way down to where the price closed at $29.25. Then our price moved down further to $28.38, so we continue the line down, and on the 5th and the 7th there was no movement because the price didn't exceed the $1, so it stayed as it was, and then we had a big collapse of the price down to $25, so the line was extended down to that $25 point over those next period of days. Now this is an important thing to take away, is the line color or the thickness, because once the price broke that original starting point, that low, it then changed color to a bearish red in my example here. So that's very important to know. So when that point is broken, then we get the change in color, not when it starts to reverse. That still stays in the way of the previous trend, but then when it breaks that low in this example, or it would be a high to, vice versa the other way up, then that's when the color changes round, or the line goes from thick to thin or thin to thick. Let's go through some examples. So here is the Nikkei 225 Japanese stock index, and I've set this to a 350 point reversal setup, which we talked about in our WTI crude oil example, and you can see this how it creates a certain layout. Now moving that size will give you a completely different picture and setup. So getting the right size for the lines is very important, and we're going to see how to do that in later sections, but really it is critical for the successful deployment of the Kagi charts. So that's the Nikkei, and I've also done an example set up on the S&P 500, another stock market index, but this time I've used an average true range of 14 to automatically create the line sizes. That's another variant, and again we're going to see how to use that, but it's just to give you a picture of how the Kagi chart can look once you've put in those inputs. So the real important takeaway here is the input to the line size. So in the exercise at the end of this section, I'd like you to play around with your chart package and just seeing how by changing the line size you can get very different results to the same chart, which of course you couldn't do by using a bar chart or candlestick chart, which is much more deterministic in its setup. So there is some subjectivity here to using a Kagi chart. One of the big things I've found with Kagi charts is that they are especially good for dealing with your trading psychology, and for most retail traders, trading psychology is one of the hardest things to master. So if we can use a chart type that helps us, then that's all good, because unfortunately, like in anything, our brain gets in the way. It's just human nature. We make mistakes, we want to succeed, we fiddle, we tinker, and it's very difficult to be consistent and disciplined. And we don't all have the programming skills to be able to, sort of out-program that bad stuff that we've got in our heads, and it's very difficult for us to follow rules. So we need something to help put the odds on our side, and that is what Kagi can do, and it can help us start to be consistent in our trading, and that brings massive performance results to us, and it helps us analyze our trades, what we've done, more easily and understandably, so we can pull them to pieces and work out how to become better traders. I found when I've been teaching people and looking at their results, and even my own trading and even professional traders, I see that trading involves 80% psychology. Even when you're a programmer, you still tinker and try and inject what you think should be in there, which can lead to bad results. Most of what you need to know is only about 20% of the equation, but it's going to take you about 80% of your time to learn the 20% knowledge. So that's the frustrating part about the trading, and you need to start thinking like the casino owner rather than the gambler who goes into that casino, because there is only one winner overall at the end of the day, and that's the casino owner. And like I said, in this space, well, that involves using Kagi charts. Let's summarise how Kagi charts can help us. Well, we're starting to see how they could possibly aid our trading psychology, but they're going to help give you an edge, a different angle approach to your trading. They're going to take away some of that emotion, and I found them a great tool for being automated if you've got those skills, and very useful for coming up with simple, effective strategies. And for me, like these Kagi charts, similar to Renko and line break, they're built for purpose. They're going to create discipline and structure, simplify the complex, give us some clarity and transparency to our trading, improve our decision making. And these were all the elements that the Japanese, when they first created these charts, were looking for. They're making things simple but effective. Now, before we really go on and dig into the Kagi subject, you're starting to see that the time issue, although it shouldn't really exist, is sort of lurking in the background there, and the setup, getting the correct yin and yang line sizing, is of critical importance to the successful implementation of Kagi charts. So before we move on any further, we've got to address and understand these two issues. Firstly, we said that Kagi didn't deal with time. Well, that's not quite right, because we actually do need a closing line in the sand for where to, either start our chart from, where to close that price off from, so we can create our lines. Simple as that. But where modern advancements in charting have sort of added in more time element is that you can change the time period that you are looking at in these Kagi charts. It's very hard when you're drawing these charts by hand back in the late 1800s, but now we can fiddle and tinker a lot more, so it's sort of brought in the time element into our Japanese style charts and Kagi charts. So if you want to be a faster trader, you might want to look at the 1 minute Kagi chart, or you're a slow paced investor, the weekly chart, the monthly chart. You can do that now, and that creates issues that we need to address and understand. So let's take a look at a time example in Kagi charts. So here we have the US dollar against the Japanese yen currency pair, and currently we've got a 1 day setup, and the size of the lines is at 0.5. Now if I then change that 1 day down to 6 hours, we've kept the size the same, but we've changed the time period. And if you can see along the bottom axis, actually the dates that it's actually looking at has changed as well. And again, we can go further down. We could change it to 1 hour if you wanted. Again, still at 0.5, and again it shortened the time period that we're looking at in our time horizon. And we can go down even further. Let's go down to 2 minutes, and again we've got a different picture to look at. Again, very short period of time, not a lot has moved within that's quite a wide range in a 2 minute chart. 0.5 on the Japanese yen pair there. So we've got some things to think about. Now in our example down the US dollar yen, we kept that line size the same at 0.5 through all those different time periods. We've kept it constant, and that may or may not be appropriate for your trading. A 0.5 move in a 2 minute chart is quite large, and you might not get any action whatsoever, but in a 1 month chart that might be appropriate. So you can see how time now is interacting with our line size function and highlighting the need to try and create an appropriate process, a way of systematizing our line size that we can then get the right line size amount number in there, so we've got the best chance of using our Kagi charts appropriately to what we're trading. Another way of seeing this is if we looked at a Kagi chart versus a standard bar chart over the same sort of time period of data on, let's take any example, a 15-minute bar chart and Kagi chart setup, and we can see the differences between the two. So again, we've got our US dollar Japanese yen chart set up here. On the right hand side we've got a bar chart, on the left a Kagi chart. Now on the right hand side is a 15-minute chart over the last trading day, in this instance the 2nd of April, and on the left the Kagi chart is set to 15 minutes time frame, but we've left the block size at that 0.5 size. Now here we can see a lot of data on the bar chart on the right, the downs and the ups of the day, but actually if you look along the axis at the bottom of the Kagi chart, it actually covers February through to April, the beginning of April. And so actually if you were using the Kagi chart on the 15-minute setup, you'd get no trade. So it's saying to us that the line size isn't appropriate. So if we just quickly played with that line size, we can start to see how by playing around and finding that correct setup, we can get more action, or more appropriate action to what we're looking at on the Kagi chart. Here I've just set it to 0.05 on the Kagi chart instead of the 0.5, and instantly you can see actually by doing that quick switch we actually cover a similar looking period to the bar chart on the right. And actually, because we've now got a similar looking period, and the way that the Kagi makes things more simple in its analysis, the blacks to the reds, the reds to the blacks, in a more consistent way over the bar chart, we've now got something that we can use as a much faster paced trading tool. So again, emphasis on getting the right line size for the Kagi chart. Some further thoughts on that previous analysis is that which is very important to realise, until that time period closes, so again we're introducing time again, the lines that are created are only ever temporary. So you might come across an instance in your charts that you see lines disappearing before your eyes as the price moves for and against whatever direction it's in. So these lines are sort of temporary and can create complications for your trading around false signals and make getting the line size even more important. You get it too small, the line size, these lines will come and go. Too long, you get no trade. So how can we better come up with a line size that is appropriate for the market? Foreign exchange is less volatile than equities, so we need something that works within the asset market that we are trading. And there is one way of doing this, and this is using volatility. You may have come across the concepts of volatility before in other forms of your life, but in this instance, if you haven't, then volatility is simply a measure of the variation of a price or financial instrument, i.e. its uncertainty. So the more volatile something is, the more the price is going to move around. The less volatile, the less it's going to move around. So we need something to measure this. Now if we're using technical analysis, one of the easiest ways are to use two tools that they provide. One's called ATR, that's the average true range, and the other is historical volatility. Now on this course we are going to concentrate on ATR because that is one of the direct functions of the input to the Kagi chart. If you want to explore further, historical volatility is also commonly available and produces similar results, just a slightly different angle in on coming up with the same sort of numbers. So a quick example here using crude oil, US crude oil, WTI, on a daily chart to find the average true range or the volatility of the asset. Now we've set it to daily, so if we're going to use ATR, the results we're going to get are for the daily movement. So we go up to our indicators, this is using TradingView, we put on average true range, and down the bottom of the chart we now have this line, and it's reading off 2.6 roughly for the 1st of April, and that means that in any day that crude oil could move $2.60 on an average day. Now the inputs to the ATR for this to come up with that number if we go to the settings, actually show us that that's over 14 days a period. So that's looking back 14 days to come up with that $2.60 number. So again, subjective to what you use. I try and keep them standard 14. If I want to speed it up, go lower. 5, 7, 10. You want to slow it down, 20, 30, 50. Up to you and your strategy. The time period you're trading as well is important for that, but in this example we can see how the average true range has increased. The volatility has picked up from $1.20 in the middle of February per day up to now $2.60. So that's saying to us that crude oil is more volatile, and it's this input that we need to know for our Kagi chart. So we take that from this standard candlestick chart or bar chart over to the Kagi well, which we will look at further soon. So some exercises for you now to round off this section. So let's take a look at the math behind the creation of these Kagi lines. So first of all, don't worry, it's not that difficult of a subject to master. It's all about the process. Once you've got the process nailed down, then it does become a lot easier. And if you're familiar with Renko charts, it's pretty much virtually the same way of doing things. So all we're going to need for your Kagi chart to create these lines is a closing price in a time series format period, and that is down to you, whether that's weekly, daily, hourly, 5 minutes, 1 minute, whatever your trading time period is. So let's take a look at a simple example to kick things off. So let's navigate around this example. We're looking at the Nasdaq 100 stock market index. It's set to a daily time frame in the window, and the input is set to an ATR 10 periods, and that has come up with a number of 350 for us, and then that has produced this view of the Nasdaq 100. And as you can see from along the bottom there, it does go back quite a way to the end of 2019 all the way through to April 2021, and we can get a general idea of the trend. Looks rather bullish overall, but as you can see, depending on what type of trader you are, you're a day trader, long-term trader, the input to that ATR number, the 350 we're using here, is very important, because you're not going to get a lot of action, I can tell you from my experience, on this current chart setup. So where would we go to change those settings? And this is again in Trading View. Well, we'd go up to the title here. You can see this line. We click on there, we go to settings, and the methods in Trading View that they allow you to use are the ATI or traditional. Now the traditional I call fixed. That's where we plonk in a number that we create ourselves, and the ATR is calculated automatically for us. Now we're going to explore both these methodologies going forwards, and there are others in other charting packages like percentage amount, but if you include the percentage amount, probably most of the ways of calculating are done within these three. And if you want to play around within Trading View, if you've got that charting package, you want to change the ATR to a faster number to give yourself some more action. Let's change it down to a 5 and see what happens. Here we go. Actually, that's even elongated it back further in time, so speeding it up there helped us not very much, other than giving us a longer term picture of what's going on. And you can actually see that the ATR of 5 has given us a line change amount 450, so that actually increased. So if we want to decrease the number, we could go to the traditional setup and take that number down. So exactly the same, go to the settings, go to traditional, flip it to traditional. Let's say we want 50, let's be really super aggressive. There we go, let's pull that so we can see. So instantly you can see the screen's filled with a much shorter period of time, and that would give us a lot more trade action. So from that example, hopefully you can see how important it is to get the right size to work for your trading, and hopefully you've also seen that there are different approaches to calculating the line size. The fixed value, or as TradingView called it, traditional value. We've got the average true range, and we mentioned also the percentage of price move. So we're now going to have a look at how we can calculate those 3 different approaches. Before you can move on to actually doing the nuts and bolts of coming up with these line numbers, there's some considerations and thoughts you've got to put in to the number that you're going to actually come up with, and I've listed some of them here. Do you have a long or short-term view of trading? What sort of price moves do you want to isolate? How sensitive do you want to get to the price? What have past prices done? We talked about capturing that through volatility, for example. What drawdowns, losses, are you prepared to accept on the trade line size that you set on the Kagi chart? But the most important thing here is to create a systematic approach to this line sizing, but also to be consistent with that approach. So first up, the traditional fixed value approach. What does that mean? It means that the line size will remain constant at the size that you pick, and will not therefore factor in volatility. So if you picked a line size of 1 and you applied it to crude oil, GBP, USD, the FTSE 100, that's what it's going to stay across those assets. And as we've come to see, that wouldn't be correct. Each of those behaves differently. We've got to model it accordingly. So we're going to need a different fixed value per asset. So the question is, how do you come up with that fixed number? Well, that could be on experience. You might be very familiar with how crude oil moves, for example. Your knowledge of the market, the product, or like I come up with a slightly different methodology based around volatility, but I create a fixed number off the back of that, and we're going to see how I come up with the number. But it is a very subjective approach to coming up with a variable for this method of creating the line size. But we're going to have a look at an example and play around with some numbers. So here we have crude oil, and it's set up on a 1-day look time frame, and the traditional fixed size is set to $5. So that means that the lines will only change when it moves past that $5 amount, and we can see that actually we have a very long-term view with the $5 set up on a daily chart, and that goes back to 2016. It covers the highs around $80 all the way down to the lows, and when we hit that minus 40. And again, is it appropriate? Is your knowledge such that you like it at 5? Are you a long-term trader, investor? You just want to invest for the longer term. But if you're not, you might want to change that number down. And again, it's very subjective what works for your trading approach. So again, let's take it down to $1 and see what happens. Well, instantly we've got a lot more price action. We've got a time period that is much shorter. If I just change that, tidy that graph up a bit, we've got the -40 down there to the highs in the early 60s, but by taking it to $1 we've got a lot more action. And further still, we could speed it up again. Let's change it down to, say, just for argument's sake, 20 cents. Now we've got really only the latter part of 2020 and 21 in there, and again a different perspective on the same market on the daily time frame. And you might want the daily time frame as your starting point, but others might want a different time frame. And again, it's the same process. You know, go up to your charts. Say we want to trade the 1 hour on 20 cents. Again, we've got a very different picture. Once more, we've kept, you know, that 20 cents, but changed the time frame. And you saw that previously the axis was, you know, the time axis was for a lot longer period. By just changing down to 1 hour and keeping it at 20 cents, we've now got intraday action available to us, and quite a lot of it. So just playing with that fixed traditional number can create all sorts of views. How do you know you got the right number? That's the subjective part. You can maybe be able to back test it if you're, you know, a programmer. Trial and error, investing small amounts into your trading to see what happens, putting it through into a spreadsheet, downloading the data, you know, just eyeballing whether it works. Many ways, but really the traditional way's a bit too subjective for my way of trading. So our second approach is average true range, ATR. We looked at ATR briefly and the idea behind it, and as a measure of volatility, and it's a really important concept. I think this is much better than using the fixed traditional approach straight out, because it adds in the peculiarities, the behaviour of any market you're looking at. But it does have its weaknesses as well, and it's pure approach. And again, I modify that for the purposes of coming up with a better, you know, methodology. But you will find that if you left it on the ATR mode, your numbers and charts change around a lot and make it very hard to back test. So when I'm using ATR, I like to leave it pretty much as standard. Most of the market will probably be using the standard approaches rather than trying to backfit the numbers. So 14 days is a good starting point. And the average true range, apart from being the good input here, is great for working out breakouts, you know, stop loss levels, and therefore very good also for risk management purposes. So some further thoughts on the use of ATR. I've said about the standard, you know, setting. You know, I normally leave it at 14, but again, you can play around with it to become more or less sensitive to where you want to put it in your trading. Like I say, it does take into account volatility, and that's good for what we want to do. But you know, the ATR is very flexible, and there's many different approaches to calculating the number. Experiment, find out what works for you, what doesn't, what works for the asset you're trading in the market. But you've got to test it thoroughly, and whatever you do, make the approach systematic and consistent. So let's go through an example of getting the ATR out of a traditional bar chart or candlestick, and then applying that to the Kagi chart. It's a rather simple approach. So here we're using WTI again. It's on a 1 day setup, and on the right hand side we've got a candlestick chart with the ATR indicator below that, and on the left we've got our Kagi chart, and that's just randomly at the moment set to 0.2. so 20 cents. So at the moment though, the candlestick chart is showing us an ATR of about 2.6. So in its simplistic terms, we would then take that 2.6, go to the settings, change that 0.2 to 2.6, and that would be our new setup for a daily chart. So at 2.6 is $2.6, and again, that's if you want it, this is your strategy, your style. But again, remember, we can tweak this for time frames, speed up the numbers. We're going to look at a different approach to how I would use this ATR, but this is a really quick and simple way of calculating the ATR. And let's just have a look at changing the time frame. So on the left we change the day, we go down all the way to 15 minutes, and we're going to change this to 15 minutes, the Kagi chart. So what ATR do we have in 15 minutes? Where we got 30 cents. So we go back up to the settings and change that to 0.3, i.e. 30 cents, and then we've got a ATR number. If we move that chart out, more appropriate for that time frame. So simple way of coming up with an ATR input approach. Now our final method here is for a percentage move for the line size. Now I think this is slightly better than the fixed approach because it does factor in a percentage rather than a numerical amount. So in that instance it is okay, but where it falls down, 1% move in FX is very different to a 1% move in stock. So you could be taking in and out of trades. It might not be appropriate, so you have to be very specific to the instrument you're trading or analysing. And again, it is a very subjective process, but again, if your charting package allows you to do it, have a go, see what results you come up with, experiment, test, and if percentage moves for you, try it. It's not what I use, and we are going to see that next. But before we get onto there, a few exercises for you to do before moving on. So my approach, slightly different to what we've seen before, but essentially built off what we already know. Now, You don't have to use this, it's an example. You could use one of the 3 methods already if that's what you want to do. I'm just throwing this one out there because it works for me. It's a systematic, consistent approach that I apply to coming up with the line sizes in the Kagi charts. Firstly, I like to assume that all categories of instruments that I'm looking at have some sort of volatility band, annual band around them. So for example, FX normally moves between 10 and 15% annually, and as you can see, progressing through like indices, commodities up to equities at probably the most volatile between 25 and 100%. So I use that as a ballpark guide to the instruments I'm going to trade as a starting point. But as we've seen, we need to find out what the actual volatility is, and you could use historical volatility, or as we've seen, we're going to use average true range. So let's start from a daily time period point of view on the Kagi line size approach, and the first thing we need to do is just get our bar or candlestick chart set up to that daily time period. We go through that same ATR approach as before. I've left the default setting to 14, but you can change this, and because the ATR value changes, what I want to do is try and smooth out that volatility just a little bit so I can get a more so let's call it consistent volatility, because you might have some days that spike are not sort of a good example of what historically happens. So I use a 50 period moving average on top of the ATR indicator to get my number. As you now know, we take that ATR number, and this is the moving average number that I'm taking now. I then take 20 to 30% of this number for the Kagi line size, and it depends on your level of aggression, how many signals you might want to get, whether you want to go 20%, which is more aggressive, through to 30%, which is more conservative. But I've taken the ATR number and basically taken a fifth to a third of what is being produced there to give me the action that I want. And what would you do in different time periods? For example, weekly, 1 hour, 15 minute, 1 minute. Exactly the same process, but you've got to remember to marry up your bar chart or candlestick chart to the Kagi chart. So if you're using a 15-minute bar or candlestick chart, then you're going to be using a 15-minute Kagi chart, because you're going to pull that 15-minute candlestick ATR number off and fire that into the Kagi chart. And again, it's exactly the same. I take 20 to 30% of this number. Again, that's up to you on how aggressive or conservative you'd like to be. So let's take a look at how I would do that. So again, sticking with our crude oil example here, this is exactly the same setup as we saw previously. Now in the bottom right hand corner we have the ATR, and what we're missing is a moving average to smooth out that data. So to add on an indicator to the ATR, I right click onto the ATR, add an indicator onto that, find a moving average, that's applied it there. I then want to change that to 50 periods to smooth that out nicely. So we just change that from the 9 to the 50. There we go. And actually we can see in the longer term the volatility has been a lot lower, more towards the $2, the late $1 to the beginning of the $2 range. So 180, call it 190. And like before, all we then do is go over to the Kagi chart, change the number to the $1.90, but that gave us the first part of the equation. But like I said, we were after a 20 to 30% move. So again, what's 20 to 30% of that? We could have about 40 cents, say, for example, as our number. And again, we just change that finally to the 40 cents, and that is the Kagi chart setup that I would be looking at on the daily window. So actually we've got a lot more action, and I think it's more appropriate to the volatility of that instrument. So taking that further, we maybe want to trade in a different time frame. We talked about the 15 minutes. Let's change it all to 15 minutes. So we now have a 15-minute chart over here on the right hand side of crude oil. We have a new ATR number, and in a 15-minute chart it's 30. And so let's take 20% of 30, so we've only got a 6 cents move, so it's quite aggressive. And let's change that to 6. Remember, this is just an example, okay? I'm playing around with numbers. The 6 cents you might find doesn't work for you. This may be more moving into the scalping world. Again, remember the spread that you're paying, the cost of the transaction when you're using these tighter numbers. But this is just to show you how you can manipulate and change the Kagi line input to be appropriate for the time frame that you'd like to trade. So there you go. That's my example of how I like to do it. So again, before moving on, some exercises for you to play with before we get on to the next section. Practice and repetition are great for success, so we're just putting things together here over what we've done so far. So I've given you 4 particular markets to look at. If you haven't got those markets, don't worry, find 4 of your own. But what I want you to do is set up the daily and hourly ATRs on all of those markets, or whatever 4 you want to do. Then practice and just play around with those charts, experiment with the line sizes and the different 3 approaches that we have looked at: ATR, fixed, percentage, and then apply the 4th methodology of my approach, my way of tweaking sort of the ATR fixed way of doing things. And really it's all about just keep practicing, getting familiar with the methodologies, and then you want to really finalize what you think's best for you, so you can then start to create a systematic, consistent approach to coming up with those line sizes that you can apply across all markets and asset types. Now, Kagi charts are multi-talented. They can be used for all sorts of trading permutations, price action, getting rid of the noise, how you're trading, breakouts, reversals, trend following. They suit all different types of trading style and strategy, swing, day, longer term. Very good for risk and trade management, and also in supplementing other charts and decision making around those other charts. So all in all, a good chart to learn and understand and use. So if we go back to the original rules of Kagi, then it created one that basically said when those lines alternate colours or thickness, then that creates either buy or sell signal. So for example, you buy an underlying asset when the line turns from red to black in my setup, and remember you can change the colours or use the thicknesses how you like, but that is the fundamental basic trading rule, i.e. those lines changing from one colour to the next. This rule though comes with a big warning attached to it. Just trading that line change colour as your entry and exit approach or strategy is going to cost you a lot in the long run. You might get lucky for a bit, but eventually, probably more sooner rather than later, you're going to lose. You're going to get chopped up, spat out really. So rule is, don't use the basic rule just to trade on. We're going to look at other methods to support and enhance this basic rule, but please remember, don't just trade the change of line colour / thickness. So here's an example of that buying and selling in action. This is the FTSE 100. It's 15 minutes, so it's quite fast paced. It's on an ATR of 5 settings, meaning that every 4.5 points we're going to get some sort of move in the line colouring. So like I say, it's speedy, but essentially in like sideways trading markets, it's really dangerous unless you've got supporting evidence around what you're doing to trade those change in trade, like Kagi line colours from red to black or black to red. But it's easy to see how much clearer that does make your decision making, and can add some consistency to your trading. But like I say, you've got to get the inputs to your strategy right before you start trading those sort of rules. So back in the day, the Japanese enhanced their charts with price pattern analysis. They didn't have the tools and sophistication that we have today, but they had very interesting, detailed, subtle ways of analysing the Kagi lines to give greater confirmation on what was going on inside any market they were looking at. And we are going to have a look in a minute on, in the next section, on price patterns. But on this example, on the Nikkei 225, you've got some of the new terminology that you'll come across: falling waists, rising shoulders, support and breakouts created around trend lines, and there's many more that we're going to see shortly. Now this is one of my biggest tips for using Kagi charts. Now I find Kagi charts best used as a more specific Price action tool. What do I mean by that? Well, many of the technical analysis indicators and add-ons that you can put onto other charts, that when you try to put them on the Kagi charts, don't work very well. So unlike Renko charts, for example. But what works well is the more specific price action tools and indicators and analysis that works directly on top of the Kagi Yin and Yang lines and not derivatives of. And like I said, we're going to explore more of that within the next section and on the following section 3, where we look at adding on further sort of Western indicator analysis onto these Kagi charts. I'm going to throw out that warning again. Please do remember, buying and selling simply on the change of the line colours is dangerous and unreliable. Don't do it. You'll see better ways of doing it going forward, so don't rush off and try to just do that buying and selling around that idea. Be patient, learn these other ways to supplement the power of the Kagi chart. Now what you'll notice about Kagi chart patterns is actually they're very similar to their Western counterparts in, say, bar charts or the candlestick charts. You'll be familiar with the sort of shape of a lot of these. They have slightly different names that you'll need to learn in the Kagi chart world, but also there's some very subtle and clever analysis which is unique to Kagi that's worth learning, which can seriously help your trading and create very specific trading strategies. In this section we're going to look at shoulders and waists, price breaks, line lengths, reversal line points, double windows, tops, bottoms, trend lines, Buddhas and shoulder or waist chains. So a lot to cover off, but like I say, very useful for you to know and learn. So our first Kagi chart pattern revolves around what's known as shoulders and waists, which is unique to the Kagi chart. A shoulder is a prior high and a waist is a prior low, and what it can be used for essentially is to gauge the sentiment of the current trend. So you look for a series of shoulders or a series of waists to give us an idea of the strength of that trend direction, and we can also look for a reversal in that strength where the current shoulder or waist is either lower or higher than the prior shoulder or waist, which can signify a change in supply and demand. Let's now look at an example of that. So here's our example on the S&P 500 stock index. I've marked on shoulders and waists, and we can see the shoulders are basically turning points at the end of a bullish up run, and the waists are turning points of a bearish down run. Now they may continue, they may not, but they are important points on the Kagi chart to be looked at and analysed, because they will obviously tell you about the sentiment of trading currently and the strength of that sentiment as well. Next up is price breaks. Now this enhances the probability of success when those trend lines change colour. Now in this instance you're going to wait until two or more prior high or lows have been penetrated. It's up to you if you want to stick to the two. You could be even more patient, go 3, 4, 5, whatever. It's up to you, but higher you go, probably the risk return starts to run against you. So let's take a quick look at an example. Now this is an example on the S&P again, but this time it's on an hourly chart, so we've sped things up a bit, and it's a buy example. You can see in the bottom left we've turned from red to black around 3 o'clock. Now, old rules say you go in there, and yes, that would have worked in this example, but the odds are against you, so we wait until that second high is broken around that 3921 level, and we enter in. Much safer, and it carried on and was a successful trade, possibly netting you 60 points in the next hour and a half, 2 hours. So a more safe way of trading the change in the line colour. Now your Kagi line has an important centre point, and this can be a reversal line point. For example, if the price reverses after a rally but stops in the upper half of the previous line, that's a bullish indication that that rally is then going to continue as it breaks through that previous high, and vice versa for a bearish trade. If the price reverses after a sell-off but stops in that lower half and then continues to break back down below that previous low, then that's a good sign for a bearish continuation. So let's take a look at an example of that. Again, sticking with our S&P 500 1 hour chart, we can see in the left hand side there the price has changed from black to red, indicating a bearish sell-off. Now shortly after that 3 o'clock time frame, it then pulls back, but it doesn't pull back over halfway into the bullish zone, so we presume that things are still bearish, and then we will wait for the breakout past that low to then go back into a short trade. So in this instance we would have made a few points, maybe 20 points, hit and run type of trade. Again, just an example of another subtlety of the Kagi chart, and it's vice versa for a bullish setup. Now that bullish bearish zone I drew on, and it's not available, I couldn't find on TradingView, but that might be a function on your charting package to see if you can add on that sort of middle 50% sort of bullish bearish zone line. Now if you're familiar with technical analysis, the Kagi chart pattern double window tops bottoms, or sometimes known as tweezers when they're at their high, for obvious reasons when you'll see them in a moment. Very traditional type of pattern, very good for reversals, and the rules, following waist is always above for a double window top, or below for a double window bottom the previous shoulder, and you can have multiple bottoms and tops. You don't just need two, you have 3, 4. Let's take a look at a quick example. So on the left side we have a double window top, so the price has basically been coming upwards. We've been in a uptrend. We get that double top look, and we have a waist line in the middle, and we have 2 shoulders to it, shoulder 1 and shoulder 2. The important thing to note here is we're looking for a gap between the shoulders and the waist, and once that breaks down through the gap, you can trade it. I would probably enhance it further with other indicators and tools, but it's to give you an example of the double window top there. And on the right hand side we have the double window bottom, pretty much it in reverse. The price has been coming down in a bearish trend, settles down, creates this double bottom pattern. Again, we're looking for the gap between the shoulder and the 2 waists, and then we're looking, where the odds are more on our side of the price reversing back upwards. So that is the double window top, double window bottom, and like I said, you can have treble bottoms, tops, more than that, and the theory I suppose is very similar to what you'd see in candlestick and bar charts. Now trend lines are drawn like on any type of chart, whether it be bar chart, candlestick. It's the same in the world of Kagi, and the bearish trend lines are drawn above and the bullish trend lines drawn below. It's a very subjective process which we have to bear in mind, but again it's very useful for looking at or finding reversals in breakouts from trends. So it's worth often applying on top of your Kagi chart. So let's take a look at a brief example. So here we have gold Kagi chart. It's actually a weekly one, so it's really long term. You can see we go back to 2006, so nearly 15 years of data. I'm just going to draw on some trend lines in a subjective type of way. So we find our trend line drawer, and for a bullish trend we could start from here, draw the trend line up, and we have a break. Again for the downside, taking it from the corner there into there, and we have a break up there. So very easy, very quick to draw on, and helps you determine when these breakpoints in trends have occurred. Now the greatly named Buddha pattern is very similar to the traditional head and shoulders setup that you're probably used to on a bar or candlestick chart. It's a price reversal pattern, so let's have a look at how it works. On the left we have a Buddha top. What does that mean? Well, that means that the price has been trending upwards and it's created this top like pattern. If we're translating it into heads and shoulders, we've got the two shoulders on the left and right and the head in the middle, and as the price breaks back down and changes colour, I've broken through that low, then we sell it, and we're expecting the price to continue its downward trend. And on the right hand side, the Buddha top, what does that mean? Well, the price has been trending downwards. It creates a base at the bottom. Again, we've got these two shoulders on the left and right and the head in the middle, and then it breaks back up through the waistline there and it creates a buy, and the price continues on upwards. So that is the simple pattern of bearish and Buddha. Now that is the perfect example. There are variants of it, it doesn't have to be that perfect, and sometimes they're quite hard to spot, but again a useful reversal pattern to look out for. I would use it in conjunction with other indicators on top of that to confirm the reversal in the price. And finally we've got what I call the shoulder waist chain setup. Very useful for risk management or trade sizing, getting bigger, adding to your trades, or target setting. Now in Japan they use something called a 9 shoulder or waist sequence, and when it got to that 9th shoulder, they started to believe that that was the trend starting to possibly wear out, and would sort of heighten the awareness to look for signals for a change in trend direction. Quite hard to spot the 9 shoulder pattern. Let's take a look at an example so you can see what we're talking about. So here we have an example. It's daily USD JPY currency pair, and it's set to 0.5. I found a 7 wave down. Couldn't find a 9 for the purposes of this example. That's just to give you an idea of how the patterns play out. You might have a different rule. You don't have to use the 9. You might have analysed that 7 is the magic number there before it turns around. So do your research, find out what works by the particular market that you're analysing. But again, another useful bit of analysis that you can apply on top of the Kagi lines. So now just a little exercise for you to complete before we conclude section 2 and summarise the section for what we've covered and what you've learnt so far. Now, using Kagi straight up can be a difficult task, so you really do have to know what you're doing, and just relying on the old rules will get you into trouble. You're going to get too many false signals, you will kill your account. Other things that we need to know, problems you might encounter: line size is very discretionary. It's very easy to fall into the trap of backfitting the correct line size to what looks like it works at the moment, might not going forward, so you have to be very careful in back testing, and we'll look on ideas of getting around that in later sections. But if you don't create a robust, consistent approach, again you're going to fall into trouble. And the time frames, exactly the same thing. If the line size is wrong or badly thought through, then you're going to get a lot of temporary lines that can disappear and create signals for you to get into that will be fake, and again could seriously damage your account. On the flip side, you might create an incorrect number that gives you no signals at all and you sit there doing no trading. So these are some of the problems that you may face around your Kagi chart, and you've got to sort out in your trading plan and approach to using Kagi charts. And by the end of this course, hopefully you would have done that. So after completing section 2 of the Kagi course, what can you expect from your raw Kagi charts? Well, in its very simplest, rawest conceptual form, it's a very good tool to use, but it has to be understood, and you really do have to learn how those charts are constructed and applied before going live with your trading. Remember that those line sizes, temporary lines, can catch you out and make the simple quite messy and costly. So we need to enhance the chances of success, put the odds more on our side, and this is where the enhancement in charting software and technology will help us out, because we can start moulding and merging our ideas with different approaches from the West, or even different Japanese approaches, to create far more robust trading strategy methodologies around our Kagi charts. So let's summarise section 2. What have we learned? Well, we've learned what Kagi charts are, why they're useful, how to construct a simple Kagi chart, how we can define a line size approach using a systematic process. You can use 3 methods that I've highlighted, or you could use my more adaptive approach. We've seen some of the weaknesses of Kagi, we now know how to practically construct our own Kagi charts, and we've learned that as a standalone concept in today's trading world, it's pretty difficult to rely upon it, and we need to enhance it further to increase the chances of success using these charts. So now let's move on to section 3. The purpose of section 3 is to show you how we can enhance and make more powerful the original Kagi charting idea by adapting Western ideas. We have got some Japanese ones in there as well, but by putting it together we can create really strong trading strategies. And when I first started in the early 1990s, this sort of technology just simply wasn't available. You know, even at the top investment banks, you had to do everything by hand, and a lot of the ideas that are now available just weren't there either. So by the sort of late, sort of 2000s, this has now become more accessible for every type of trader. It's more affordable, and it's now open to all. So for us, that is a great advantage to have. With the way investing and trading has changed, especially even in the last few years, these ideas such as Japanese charts and tools have become more popular and available and are looking to be explored, and all of this has gone hand in hand with that technical revolution. So today we can do almost anything we like with our charting packages, trading and strategy design, but most important for us is that we can enhance our Kagi charts by adding on these extra technical analysis tools and putting them on top of our Kagi charts. And like I said and try to emphasize, that this will create a more robust, reliable and hopefully more successful way to use our Kagi charts in our trading. So to give us some idea, let's look at a quick example. Here I'm going to add on an indicator to the Kagi chart itself, and what I call the derivative of the Kagi price indicator below that price action. Now this is a totally made up example that we've got here on the USD JPY, but I'm just putting it together so you can see what you could potentially put together using the Kagi charts and other indicators. Here I've just added on a blue line, which is a moving average. I think that's a 30 period, and below the awesome oscillator. And in this setup on the 1 day USD JPY with a line size of 0.5, that gives me two obvious signals. The first one is a sell signal, and we're using the moving average and the awesome oscillator to get us in combination with the Kagi data. In June, it's a long-term down trade. The market reverses back down through the moving average. The awesome oscillator goes from green to red. It's a sell all the way down. Then you would use trade and risk management processes to keep you in that trade. Then we have the reverse in the beginning of 2021 when the downtrend turned from red to black, where we then start going bullish, but we wouldn't get in there. We've got a green signal on the awesome oscillator, but we would wait till that moving average broke the Kagi price there, which is sort of mid-February, and then we would be in, and again we would utilize risk and trade management to keep us in the trade. So a really simple example just to give you an idea and to whet your appetite on this next section. As you've probably seen though, if you've played around with technical analysis tool, you notice it has thousands of different combinations of oscillators, indicators, tools, theories that you could apply. But what normally happens to those who haven't had much experience of technical analysis, well, this is what normally happens. You get your trading in an utter mess. You're going to add too many indicators in search of that holy grail trading strategy. You're going to talk yourself in and out of signals. There's going to be no consistency, and no discipline, is going to really mess with your head, and that's going to ruin your trading psychology, and the end result is quite simple: you lose money. There's another example. It doesn't matter what market it's on, there's just too much going on in here to create a simple strategy. It's just so much mess. It just bamboozles my brain. I have seen people using so many indicators. I'm telling you, don't really need to put together combination after combination. It's just going to get you nowhere in the long run. It's too much. So what should you use then? Well, it really comes down to personal preference, experience, trial and error, the markets you want to trade, the time frames you want to trade, because some things don't work in different time frames. They're just too slow to react. Your trading goals. But what have I learnt from 25 years of technical analysis? Well, I've used about every chart going. I love the Japanese charts because they're simple and effective, and I always use them as my starting point. I've been for every type of chart, indicator, tool, theory possible, and it's this bunch of charts that suit my mindset and work nicely with what I'm trying to achieve in my trading. It might not be for you, but in my experience it keeps things simple, it keeps things effective, and like I say, we're looking for consistency, systematization in our trading, and this is what I think these charts bring you. So first rule of technical analysis, well, it's that KISS one: keep it simple, Stephen. That's what I remind myself of. And a lot of the time I've seen the best strategies are really come and based from the simplest of ideas, and they are the cleanest and easy to execute. And the aim of this course is to make your trading as clean, as effective as possible, and you're going to learn the technical analysis you're going to need, I think, for the best chance of making Kagi charts a success for you. So I always get asked, what is the best indicator to use? And there is no right answer to that. It depends on a lot of variables. Like I said, your trading style, objectives, time frames, markets. I suppose my tip here is to try and make whatever you do as generic across markets as possible, i.e. it works across different asset types, different types of volatility, instrument, different time frames. It just makes it simple, and if you can come up with something that works like that, then it's going to be much more powerful and effective, especially when you put together a portfolio of trades, and it's going to give you the opportunities whenever you like. So that makes it more a 24 hours, 5 day a week trading type system that you can develop. So then what do you pick from the thousands out there? Like I said, I use the ones that work best for me. So really for you, it's going to be trial and error, playing around, getting familiar with technical analysis, and really learning the subject. You've got to get stuck in to get out the results that you want, and it's going to be a big part of your learning curve. So I'm going to present here what I think is a good starting point for you, and stuff that works well with Kagi, and some of the tools that I use when using Kagi. But like I said, please explore, take it down your own route, because what works for me might not work for you. I'm hoping it does, but use it as a starting point and then develop out your skills and ability in the technical analysis space around what I'm teaching you here. When learning technical analysis, you don't hear much about this rule, and it's the rule of collinearity, and it's extremely important to know about. And it's basically saying don't put together different indicators based off the same inputs, because it's just giving you false answers. What you're looking for is putting combinations of indicators and tools together that give you independent answers, but the same answers that you're looking for. So you can have bad combinations of indicators. For example, the RSI and MACD rate of change are all based off closing price. So why do you want three indicators all off the same thing? A good combination could be Bollinger Bands, and RSI, which is Bollinger Bands, is looking more at volatility, and RSI is the closing price, and OBV on balanced volume, because it's giving you a volume window in there. So I've just listed a few good combinations together, but you're going to probably want a bigger picture on what to pick, so I've put together a table for you that might just help. Now this table is quite simple to use. It's got 5 columns: trend, momentum, volume, volatility, sentiment, and they all create independence that we're looking for around that rule of collinearity. So you could pick, say, one indicator from trend and marry that up to one from momentum and one from volatility. You know, the choice is yours, but try to pick one from each column for the optimal I suppose portfolio of indicators together when you're doing your analysis. So this is here to help you get started to find those indicators, and so you don't duplicate putting indicators together, which you really shouldn't do. So hopefully this is going to help you, like I say, put combos of indicators and tools together when you're coming up with your trading strategies. And this doesn't have to just be used with Kagi, it can be used across all types of technical analysis. So remember the rule of collinearity and use this table as a guide. Just a warning tip here, if you see charting packages that say they've got FX volume, that is wrong. There isn't any volume because FX isn't an exchange based product, it is interbank, and that data isn't there. So you can't use technical analysis volume indicators because they're wrong. Most volume stuff that you do see on charting packages is a feed from brokers, and it's probably more likely their client positions rather than the actual market's positions. So remember this, very important. Volume in FX doesn't exist. So let's round off this module by going through the technical analysis we're going to cover off in this course. Obviously we've touched on Kagi charts already. We're going to look at moving averages, trend lines, average true range, which we've also touched on already, historical volatility, directional movement indicator, Ichimoku, another Japanese idea, Bollinger Bands, and the awesome oscillator. So let's get on with looking at some of those now. We're now going to look at some of those tools and indicators I said we were going to address. In this instance it's trends. You may know all this stuff already, but it's no harm going over it. So what's a trend? General direction of a market or of the price of an asset. How do we measure that? Well, it's going to go up, down and sideways, sideways being trendless, and it's going to have 3 major time classifications: 6 months to 1 year, 3 weeks to 6 months, and less than 3 weeks, maybe better for timing purposes. So here's our chart that shows us through the 3 different periods in action. We got a longer term blue line, the longer term trend. We got green lines showing a medium term trend, and then under that we've got our red short term trend. So you can trade all those at the same time. You might just want to trade the short term one. So by determining the direction of the trend, you're going to come up with 3 trading decisions: either to go long, go short, or do absolutely nothing and stay on the sidelines. And remember, importantly, that the market trends roughly only a third of the time, so you need to know when it is happening. That's very important for what tools you're going to use. So here's a quick example on the S&P 500 on a Heikin-Ashi chart, daily chart. Green arrows, short-term trends, red medium, black dotted line there, the longer term trend. It's just showing you how it works on a typical market. And really the rules of trend drawing are important to know. If you have 2 touches on a trend line, that's only a tentative trend. You need 3 or more for confirmation of that trend, and that's very important to know and to apply. and it can be drawn on any charts, and you've got to draw the trend lines through the lows in an uptrend and through the highs in a downtrend, and it's a very discretionary, subjective drawing process. So here's a gold chart that I actually used in Bloomberg terminal while I was trading away, just giving you a simple example of a trend line that's touched multiple times, by 5 or 6 before it breaks. So the more touches, the stronger the likelihood of that move outwards and away, and as it did in that instance, it went flying high upwards. Here's another one, Diageo PLC, UK company, and again, this is subjective. You might see trend lines in there that I don't, and that's what makes it more subjective, less objective approach, but also very useful to your trading to understand. So what applications can we use the trend line for? Well, we can use it for price objectives, when the trend is changing, the strength of the trend. 45 degrees is a very important number. That's the optimal trend line. We can use channels to bounce prices between, and we can also do it for entering, long short positions and profit loss taking. And we can see here on the Hang Seng a typical channel example of the trend, how the price has moved up and down in a range, popped out briefly and then went back into that range. So it's a very useful tool. So here we have the S&P 500 daily chart. It's set to an ATR 10 periods, giving us a $75 line reversal amount, and I'm just going to draw on some trend lines that I see. You can see your own. There is no right answer to this. It's a very subjective process, but the obvious trends can be seen and probably seen by everyone else, so they're very useful to have. Don't forget, bearish trends are drawn above the data and bullish ones below. So let me just add on some lines now. There's two really obvious trends to this chart: the bearish one from the early part of 2020 and then the bullish one continuing up to April, and I like to try and get them through the change in the Kagi lines as well, which also helps confirmation. You can see where the bearish one switched through and turned bullish. That's also a good indication point, but again, like I say, subjective. Try and hit those line tops on the Kagi data to draw your lines through, and remember, like I say, it's subjective. Don't stress too much about the accuracy of these lines. You'll get better with practice and experience. So moving average, a great, effective, simple tool to apply onto your charts. Basically, it's, and you might have seen this in other walks of life or in your maths classes of old, it is a smoothing of a time series of data. It's easy to build and test. It's also easy to get into mess with, and it's a very subjective process, but you've got to use it as a guide to the trend more than as a trading signal. But you could use it, say, for exits, entries, in combination with other tools, but as we said, it's a smoothing of a time series and gives us that insight into what the trend actually is and takes out the noise. And there's different ways of calculating: exponential, linear, weighted. Some people use one, some people use a combination and use crossovers of those to create signals, although that can be dangerous, as I'll explain shortly. And on top of that, there's other popular methods. There's like the triple crossover, 4, 9, 18 period. There's one based around envelopes of percentage of price move. There's the Donchian bands, are based off of a 4-week look back period. We have our Bollinger bands that use an input of a moving average to help analyze the standard deviation move of the price. We've got moving averages tied to cycles, 5-day, 20-day, that can measure behaviour easily. And you've got indicators on top of the oscillators like MACD that use the moving average. And in certain markets, these rules can't be beaten, and if the price is greater than, say, the Renko blocks, and it's bullish, and vice versa. But there is a problem. They only work when the market is trending, and this is what catches people out time and time again. And we need a tool that can be used to tell us whether it's trending or not. And in my world, I use the DMI. So let's have a look at an example here. We've got Amazon on normal candlestick chart, 1 week. So it's a long period of time there to have a look at, but we've got this set up as a Heikin-Ashi chart to just smooth out the data from a standard candlestick chart, and we can add the moving averages and change them around in this section here. You can see we've got 50, 209, 20, 100 all set up, and we can unhide them, hide them. We've got the short term 9 period here. We can see how that interacts in and out the price. As we move out in time periods, we've got a longer term indicator, and as they cross through the price, we can actually then see whether it's a buy or sell opportunity, or it's trending or it's not trending. So above is the price is up, and vice versa. So we might want a longer term look at the things, what's going on Amazon, and we've applied a 250 moving average here, and the price is definitely above both in July, so I'd be more bullish. And then we could maybe use the 9 moving average to time our way in and out of a potential trade. And here's just some examples adding on further moving average time length indicators to mix up, and as you can see, you can create various strategies around this. So these moving averages paint a picture of a trading cycle, and you may have heard of the Turtles. They used a 4-week monthly cycle to create a Donchian strategy, and they made a fortune out of trading that. So here we have the S&P 500 again. This time it's a 1 hour setup. So we've got an ATR 10 periods giving us a $3.50 movement. And I've just added on, as you can see in the top left corner there, 4 moving averages, 10, 50, 100, 200, just to give you an idea of what they look like. And basically the rules for all those other charts that we've seen previously in this section apply to the Kagi chart. So you use exactly the same rule set as before to apply to the Kagi charts. Now Ichimoku is a big subject in itself, and I've got a separate course on that if you're really interested in getting into it further. But for the purposes of the Kagi course, I'm putting together the best way I think you could use it in the Kagi world. So I'm stripping it back and only utilising certain parts of the Ichimoku structure, and we're going to see how I do that by looking through a typical example. So here we have an example, more like we're putting together our first strategy really, and I've added on Bollinger Bands, which is the bluish type cloud type thing you can see, but the important part for this section is the Ichimoku cloud, and that is the green and red cloud which is highlighted, and this is only a part of the Ichimoku setup, and I use that as a trend filter. So if the price or the Kagi lines are above, I think it's bullish, and if they're below that cloud, then I assume my trade direction is bearish. It's as simple as that. And like I said, this is our first look at sort of starting to put together Kagi as a strategy tool with other indicators. But again, remember, the importance of this section is the Ichimoku cloud. So other rules you need to know is when Kagi changes from this pink to this light blue, it's a buy, and vice versa. And what have I done to the Bollinger Bands? I've actually managed to offset them. I've tightened them up to a 10 period and narrowed the standard deviations, and I've offset them 5, so sort of along the idea of the Ichimoku offset. But in the world of Bollinger Bands laid onto Kagi, and what does this do? This gives us breakout chances all through the chart by doing the offset, and this can give us more trading opportunities. So whereas we had the price breaking through the cloud, and that was a possible strategy, and then we had to sit on it for ages and ages and wait for the next signal, what we do with the Kagi is when it changes colour, we've got this example here, it goes through the cloud, then out through the Bollinger Band, we then would buy it because the line is the light blue, which signifies bullishness, and we would maybe come out on the change to the red, which signifies a bearish move in the price, or when it came back into the Bollinger Band. So that then allows us, instead of having, like I said, to wait and wait, we can go back in when it jumps out through the Bollinger Bands and out, and we get more trade action. Or you could quite easily draw trend lines on your Kagi charts and do an extra level of confirmation. You know, when it goes from red to the light blue outside the Bollinger Bands above the cloud, then it's a buy. That's just another measure you could put onto your charts, and this is in a 1 hour chart, but this can work, you know, across all time frames. It's very effective and very useful, I think, tweak to the standard world of Ichimoku. Remember that I said that moving averages don't work all the time, and we need to know when a market is trending or ranging. Now this is what we're going to look at now, and remember that markets trend only 1/3 of the time. That means there's 2/3 of the time when they're not, and we need a tool that allows us to filter whether it is or isn't, and then on top of that, certain indicators work better in certain time frames. So you can do this very many sort of different ways, and you can look, just by an eyeball test, mathematically, some rule-based approach around moving averages, and there's even indicators like parabolic SAR that I've used, but the best one in my opinion to use is the directional moving indicator, and it's developed by J. Wells Wilder in the 70s, and he just wanted to work out some more mathematical, systematic way of being able to measure such a thing. And it's made up of three parts: the plus DI, which is the upward trend movement, the minus DI, the downward, and the average directional movement, which gives you the trend range. And it's normally set to 14 periods. And the basic rules behind it: when the DI crosses, the plus DI crosses the minus DI, it's long position to be taken, and vice versa, minus through the plus DI, and greater than 25 ADX, it's trending unless it's ranging. And if you're long, the reverse point is the low made on the day of crossing. If you're short, the reverse point is the high made on the day of the crossing, and the ADX is greater than minus DI or plus DI, indicating a turning point, and when ADX is less than both DI lines, stop trading, get out. I want to show you on gold though what that looks like, and then how I develop the DMI further to be more effective for trading. So we've got a Heikin-Ashi chart, 1 day gold. We're going to search our trading view charts for the directional movement indicator. We've put it on. We see our pink line there, which is set to 14. That's the ADX line. We're just going to make it a bit more visible for you. There we go. So we've got our DI plus line, the bullish line, the blue one, the bearish one, the orange line, the DI minus, and our ADX trend filter. That you can see at the moment is pretty high, around above 40, meaning we're in a strong trending market. But we can also see that the crossing at the moment, the two lines, which could signify a trend change, and here we have an example of such a happening when it started to turn more bullish. I like to use it without the ADX though, as a simple crossover tool. So when the blue is above the orange, it's bullish, and when the orange is above the blue, it's bearish. And you can see what happens when they cross. They then create a more powerful trend change indicator. We're going to take a look at band-based indicators, and these are bands around a price range around the original price, either above or below. They overlay the price on the chart. They can be based on percentage, statistical measures, volatility, and they'll move with the flow of the price. And we're going to look more particularly into Bollinger Bands, and these are bands that are placed around a moving average at default 2 standard deviations away. And what does this allow us to see? Well, it allows us to see 95% of the price action, and as a general rule, prices are thought to be overbought when it hits the top of that band and oversold when it touches the downside. Although, as we'll see, that's not necessarily the case in all instances, but they're a great tool for targeting, maybe as a strategy, those band levels. So here's an example with gold again, a Heikin-Ashi chart. So we're now going to add on the Bollinger Bands, and we're also going to add on top of that Bollinger Band width indicator. There we go, both are on there. We've got the upper band, lower band, and what we call a basis line, which is that middle moving average period. That's normally set to 20 as default, and the two bands to ±2 standard deviations. And the bandwidth there tells us how fat or thin the bands are actually going, which can give us a pinch point in price action. Normally can explode out after a narrow ranging bandwidth, as we can see in the example there. So you can play around with the inputs into the Bollinger Bands if you want to create a more specific strategy, and we do that by simply going to the settings and the inputs. You might want to up the standard deviations that you're looking at. You might want to expand the length of the moving average, and then all of a sudden you've got a completely different look to your Bollinger Band chart. You've got a pinch point there, but like I said, it's up to you the variables you use, but try not to backfit the inputs. So we can see how the price bounces around in our new range and how the bandwidth expands and contracts as another measure tool. And here's a typical example of, in a longer term, how that pinches and then breaks up to a more bullish move. But we don't actually know from the Bollinger Band which way it's going to go. We just know that it is going to move, and that's why we'd have to use other indicators along with it to confirm the actual move of the price. So to summarise the Bollinger Bands, that they're very good at creating support and resistance levels, and you could use maybe the moving average in the middle as a trailing stop level. They're much better at determining the beginning of a trend and not trading between them, and when the bands tighten, that can often signify an explosion in the movement of the price, although we don't know which direction. And a little tip there then, if you adjust the moving average, then it's a good idea to adjust the standard deviations. For example, a 50 moving average, you might want to make the standard deviations a bit bigger, 2.5. A 10 moving average, take it down to 1.5 standard deviations. Now, just throwing this one in here, the awesome oscillator created by Bill Williams, just an indicator to measure market momentum based off of a closing price and variables, very similar to the MACD. Here's its calculation if you're interested. When we're using it in normal circumstances, we don't really need to know. What's it supposed to do? Well, it's going to tell us really when to, it's going to just give us a buy and a sell signal. And it's normally pictured in a histogram version, but I like to change that to a line view, as we will see. But it is great for creating signals, as you'll see. So here's our gold friend again, and we're going to add on the awesome oscillator. We find it in our drop down. There it is. As you can see, initially it comes in as a histogram view, and I want to change that because I'd find that a little more complicated to translate into buy and sell signals, and you'll see any second what that will look like. Just switch it to a line chart, make it a bit more visible for us, and then what we will do, we'll zoom in a bit to make it even easier to see. And now we've just got green lines for bullish and red lines for bearish, and you can see where the actual signals change. Here we got red to green, and as you can see in the price above, what a great signal that was. And you can see green to red and it turned bearish, and what a strong signal that was. So here's a tool, let's go through the chart, pick out some other examples. It's really quite a strong tool, simple but strong. This exercise is about pulling together what you've learned in section 3 and now starting to combine it with what we've learned in section 2 around line sizing and the chart patterns. It's a chance for you to experiment, to get more practice, and to start to think how you can put together your own Kagi strategies. So this section is all about giving you a simple starting point to make you think about creating your own trading strategies, but this is an example that I've put together. There really isn't much to it. We've got the Kagi chart, moving averages set to 10, DMI set to 14 periods, Bollinger Band set to 10-1 rather than 22, which is its usual, with a 5 offset. Now most charting packages will allow you to offset, and when we see the example you'll see why the offset is advantageous to us. So what are the rules of the strategy? So here are basic rules for that strategy. We are, for the line size approach, okay, you're going to use an ATR of 10. If you want to play around with that, look at the other options, my version, fixed size, up to you, but for this one we're using ATR 10. And the basic first rule is the obvious one: when the line changes colour from red to black, then we get our buy and sells in black to red. And importantly here, price is greater than 10 moving average. So when it's gone from red to black, greater than a 10 moving average, we're going to go long. And when the line changes colour from black to red, using my colour setup for Kagi charts, and the price is less than the 10 moving average, we're going to go short. And we're going to confirm this further by using the DMI indicator to help determine the trade direction. We don't need to sit there and wait for the actual cross. So if the DI plus is greater than DI minus, it's bullish, and vice versa. Our initial stop loss, we're going to use obvious levels from, say, you could pull in a Ichimoku Heikin-Ashi type setup, a candlestick chart, turning points on the Kagi chart, or other methods we're going to look at shortly in the trade management section. How are we going to get out the trade? Well, when it reverses back into Bollinger Bands, an indicator changes, for example DMI switches trend direction, or the moving averages cross, for example, or the Kagi line switch from red to black or black to red, or as again we'll see in the trade management section, you might want to use something like trailing stops to trail up behind the line, the Kagi line, or we might want to use some of those price patterns that we've looked at in section 2. Here's a tip for you: if the price is less than or greater than Bollinger Bands, it equals more bullish or bearishness. So there you go, simple set of rules. This is what it looks like. So here we have our example. It's on the Hang Seng Index, that's the stock market from Hong Kong. You can see at the bottom of the page we have our DMI setup minus the ADX. We have our Bollinger Band set to 1015, that's that grey cloud in the middle. We have our Kagi lines, and that's a 1-day chart on the ATR 10, which gives us a block size of about a line size of 505, and we have our moving average on there, which is at 10 moving average, which is the red line. And that's pretty much it. This is a basic simple strategy. So what we'll look for in the chart is our signals now, and let's pick an easy one to start with. 2017, beginning of the year, the DMI has gone from black to red, so we're in a bullish situation. Then we've got the Kagi lines changing from red to black, so that's gone bullish. It's broken the moving average, the red 10 moving average line, so then we're going to go into that trade. Now we could further wait for confirmation when it exits the Bollinger Band cloud that we've created, but we're going to go in on what we've set up, and we could then trail the price up as a stop loss method behind that 10 moving average. We could wait till the price comes back into the Bollinger Bands to get out. If we have risk reward ratios, means like for every £100 you risk, you want to target £200 or £300. If that's met, you might want to exit your trade. Really, the exit has to be systematic, has to be consistent and part of your trading plan, so you don't do different things every time the trade comes up. But this is really just a simple example of how you can start to put all those ideas that we've learned of in section 2 and 3 together to create your own simple trading strategy around Kagi charts. This is one of the shortest sections around in the course, but it's also one of the most important, and that is the use of risk and trade management processes on our Kagi chart and our Kagi strategies. So we've sort of got a rough idea of trade entry and exit methodologies, but what is often overlooked around trading is the risk management side and getting your trade to the finishing line. Without a proper structure in place, you're going to fail. Kagi is very good for helping you out here. So when we go into a trade, we need to first of all put on a stop loss, and that is a price level where we get out if the trade goes wrong. Now, you may or may not have heard of the stop loss, but it's an essential concept. It's one that I was taught first up on the trading desk, had to use them. It's an essential trade management tool. It's a tool, as I mentioned, that lets you stop a loss, but it can also let you stop a profit. These are orders that become live when they hit a predefined target set by you, and we're going to look at how we define that target. With stops in place, if the market moves against you, you just get taken out of that trade automatically at that predefined level that you set. So therefore, we're limiting our downside and our losses. There are many types of stops, and we're going to touch on a few in this section. So here is our S&P 500 1 hour Kagi chart, 3.5 points for a line reversal. This is just to illustrate the idea of the stop loss. So what if, for example, we went for whatever reason short in this zone here? Really poor timing. We want it to come down into the lower 3700s, but actually it reverses and goes against us, and the more and more it goes against us, the more we lose. So where do we get out in that period of time or price action to sort of cut our losses and say we were wrong? And this is the idea behind the stop loss, and we're going to cover off a simple idea of how you can set those initial stop loss numbers. So some things to watch out for when placing the stops, and these are really important to consider. Round numbers, because of the psychological impact, strong support and resistance lines, other psychological stop levels, stuff that's been talked about on the news or social media. If not, you're not aware of them, you're going to get picked off by the stop hunters, and they have a vested interest in pushing those prices just around those stop loss levels that you've set to take you out and to make their money, especially when they're pushing billions around. And this is even made worse by the computer systematic trading high frequency guys who also whip you in and out to make big profits on small movements. So be very careful of where you place your stops. So we're going to look at creating that initial stop loss point, and I call the initial stop loss point price level and trade entry level, the difference between the two, as 1R, i.e. 1 unit of risk. We can have multiples or fractions of this risk level, and it's useful in the trade management process to define. Now I'm going to go over a simple methodology around the Kagi framework on how to create our initial stop loss, and I'm going to throw in ATR, Fibonacci, which I'm going to cover off in its workings so you understand how to use that in a minute, but we're just going to use it for illustrative purposes here, and the use of the Kagi lines themselves. So let's look at the example. So here we have our S&P 500 index Kagi chart on the left, 1 hour still, set to $3.5 points of line reversal, and on the right hand side we've got the standard S&P 500 candlestick chart set to 1 hour, because that marries up to the Kagi chart, and below that we have our ATR calculation, with the blue line being the smooth moving average. And quite simply, how do I start my process? I've looked on the left hand side and I want to be bullish on the Kagi chart. I think it's going to turn around, go up even higher. I'm just making it up for the purposes of this example. So I then go to the ATR, and we've roughly got an ATR number around about 6. We're going to call it 6 for the purposes of this example. So first of all, I go to where we are today, 40.40 roughly. 6 points isn't very far, so that's only going to take us down to 40.32, and to me that is too close, especially if I'm thinking that my 1 hour trade might last the best part of the day. So the second part is to multiply the initial 1 times ATR by a factor, and this can be varied on what you decide or what you've back tested, but I use somewhere between 2 and 4. So for this example, let's just use 4 for argument's sake. So 4 times the 6 is 24 points, so we've now got down to 40.14, so we're starting to move away from there. So we're still quite close to the action. So at the moment I've got concerns in my head where the level should be, so I now bring out my next tool, which is Fibonacci, and I'm going to cover Fibonacci, so you'll be able to do this and understand what I'm doing in a minute. But we find the Fibonacci tool from our selection, and all charting packages should have this. We find a high and a low, and actually the first Fibonacci line interested me is coming at 4001, and I was sitting up here. So what I'd now probably do, if I want to be as safe as possible, take that down further into that line there. If I wanted to be more risk taking in my approach, I might take a shorter Fibonacci line. Let's just remove that other one and look for the different levels. 4010 looks quite good to me, so let's go more aggressive. I'm going to go 4009-10 around there, and I would be looking to put my stop loss just that side. I'd also look at the shape of the Kagi itself. We have this turning point here and a break point there, and that's just under the 4000. That's probably a psychological number like we talked about in our stops. So you want to be more conservative, you might come in here. Now another thing you could do is you could put moving averages that would follow the Kagi, and you could put it under those moving averages. You might have a short one that you use to put the stop under, but this is a simple process to come up with an initial stop loss amount. So let's just recap the rules of my approach there. Well, it is a process of refinement. I started with the ATR reading of 1, taken from the candlestick chart using the ATR indicator. I've then multiplied it out by 4 to see where that sat. I wasn't too convinced, so I just wanted to see whether that married up to any Fibonacci lines. I looked at sort of longer term and a shorter term, more aggressive Fibonacci process. That married in with the 4 ATR on the more aggressive line, and then I looked at what was going on in the Kagi world. The lines itself, was there support and resistance, any key turning points available for me to look at, and I could have gone further and applied moving averages on top of this still, but I got my stop level. That's what I'm going to use, and that's where I'm going to start my sort of trading from. And it seems quite long-winded process, but I can tell you once you get experience and into it, it'll take you seconds to work out these numbers. Soon you'll be able to just do it by looking at the charts. So there you go, that's the rules for my approach. But like I say, experiment with your own, but make it systemized and consistent if you adopt your own processes. So some rules for the initial stop loss creation: be consistent with your methodology, make it as systematic as possible, otherwise you won't get the results you want, or you won't be able to test those results because what you're doing is too inconsistent. And take into account the volatility of the instrument. That's by using something like ATR, like we've talked about before. The FX markets aren't as volatile as the stock market, so we want to factor something like that in there as well. Too close, your stops, and you're going to get taken out. And too far away, you're not going to make enough money, or the money you should. So getting that stop loss level right is very important. Some further thoughts. It depends on how aggressive you want to be, but that'll affect your win-loss ratio in terms of the stop loss setting. Other methods to consider: Bollinger Bands, linear regression. It is actually a very big subject, stop loss and risk management, and that is all for another course. But for now, you should have a strong starting point to create this trade management process, which is going to help save you money in your trading and in the long term make you money. So I promised I would look at Fibonacci. Its theory and application has become almost a self-fulfilling prophecy. It's very popular in technical analysis now and in algorithmic trading. And the basics: prices retrace to a given certain amount, and the theory behind it: behavior of groups follow patterns that lends itself to analysis, for example the financial markets, and it generates movements that you can anticipate in advance by using appropriate analytical mechanisms, e.g. these Fibonacci numbers that are self-populated on your charts, and we saw in a previous example. Fibonacci was actually a 13th century mathematician, and he was credited for the number sequence. You might have had the misfortune of studying that in maths, the 1, 1, 2, 3, 5, 8, 13, 21, and it's used in all sorts of areas of, even things like architecture. And as you progress along that sequence, the ratio of each number to its preceding number approaches closer and closer to the golden ratio, which is approximately 1.618, and each number is approximately 0.618 of its successor. All highbrow, but all we need to know is that this strange concept does work in technical analysis and on Kagi charts, and it works in all time frames. In basic form, 4 numbers are plotted, and you find those 4 numbers by picking a obvious high and low on your charts, and the key numbers to look out for: 0.618, 0.5, 0.382 and 0.236, and these are generated for you. They're percentages of that band between the high and the low, and people do use this to create and find support and resistance levels and targets. It's a very useful tool to master. Here we have a great example on a candlestick chart on the FTSE 100. Now I found the high and the low, which are obviously sticking out like a sore thumb there, but once you've done that, the Fibonacci tool plots the lines in between that band, and just look where those red arrows are, how the prices have bounced or retraced, found support at those levels. It is pretty marvellous, and like I said, this works in all time frames and can give you areas of where to put stop losses under, or potentially target up or downside moves, continue your trade, and as we'll see also you can trail your stops behind these areas as well. They do work. It's self-fulfilling. More and more people are using it, and like I say, you've got to understand how to calculate these and use these in your trading. I'm just going to look at a brief example again on the Kagi chart so you can see how I come up with the high and lows to get you started. So here we are back with our 1 hour S&P 500 example again, and we're going to learn how to put Fibonacci lines on the charts. So the first thing is it's an eyeball of the chart. Where are the obvious highs and lows? Now I try and create a fast Fibonacci, a medium term Fibonacci and a long term Fibonacci, and if those lines overlap, to me they're more important points. So what I would do, probably start with here, is go for the longer term. In an hour we're talking days, and we would go to that low to that high. I would then create a medium term look, which actually we've got this one sticking out down here, which it also probably features as a short term looker as well. Back to the only obvious high that's still here, and a short term one, well maybe it's this support zone of this low here and there. Now that is starting to look a mess really, so if we zoom in on that some more so we can actually see the detail, we're getting a sort of a roadmap of short, medium, long term support and resistance. And as you can see, obviously this is a key level we're at the moment because it's at the high. We're just pulling off the high, and I'm just going to look down. There's not much overlapping really. We've got this zone here that seems to be quite key, which is just under the 4,000. So to me this would probably be an important zone to put a stop under if I was into a longer term trade. And then I would just see how, you know, the waists and the shoulders line up with some of these lines. See, we've got a turning point here, 38.2, a key number just under 4,000 again. Have I got anything longer term? You know, around here seems to be a lot of noise at 39.21. So you can see this is a simple way of starting to get a roadmap of where price wants to go to and where it doesn't. So like I say, practice on your charts to do something similar. Try across different markets and time frames. So let's touch on whether a trade is worth doing or not, and we term that risk reward. It's, you know, how much you're going to put up, you know, afford to lose against the potential target of the trade. And it's done a simple ratio calculation that you can see there. The reward is the target price minus the entry price, and the risk is the entry price minus a stop price. Notice how we're bringing in our initial stop process to this concept as well. So how do we know? Well, we put the numbers through the risk reward. We've got back tests. We might have our own live data, but we need to, I think, probably first have a look at an example to see that in some sort of motion. So what is a good risk reward number? Well, the answer is it depends. It also depends how many trades you win. So your winning percentage is also very important, because potentially you can only win 2-3 out of 10 trades, but if your risk reward is very high, you know, 3-4 to 1, then that doesn't matter, you're going to be profitable. But if you've got a low risk reward, maybe 0.2 to 1, 0.4 to 1, then your win ratio has to be a lot higher, around the 90%, if you want to make money. So it's very important to know these stats. And in this example, in the bottom right hand corner, we've got a gold example. I've drawn it quite crudely, but it illustrates the point. For whatever reason, the analysis says that stop loss wise, we want to go out under 900 with our stop loss. We're getting in the trade at 1100, and we've got a target of 1500. So this gives us a 2 to 1 risk ratio. Why? Because 1100 to 1500 is $400, and 1100 to 900 is $200. You divide the 400 by the 200, and that gives you the 2 to 1 risk ratio. So that would be a good trade, especially if you were winning, you know, 50-60% of your trades. So starts to get you thinking about trading strategy, the statistics and performance behind it as well. So some more on getting out of a trade. Profit stops. We talked about stop losses and getting out of bad trades. You can use profit stops as a target measure. So in our gold example, we could have placed that at 1900 and we could have gone away and it had done itself automatically. These can also sometimes be referred to as limit orders. So here's a real world example on gold, and it shows you really how I've gone about creating these up and down sides. I've used the Fibonacci lines. I'm bullish on gold. I've created targets. I've created exit areas if I'm wrong. I then look at the numbers and work out whether the trade is worth doing or not. And these are the sort of things you've got to start thinking about in your trading. It's more than just getting into the trade. It's how you get to that finishing line and turn the trade into a successful one, or minimizing the risks and the downside of the bad ones. So here's a concept for you to consider. Instead of using fixed targets, why not stay in the trade longer by using a trailing stop? Don't close out your trade, trade it. What do I mean? Well, a lot of traders have fixed profit exits in their head, or a set system like those orders we talked about. But when the profit's taken, they see the market continue in that direction, and they could have doubled, trebled, quadrupled their profits and get frustrated. So how can you get around that? Well, you trail your stops, and it's a hard approach to employ psychologically, but can lead to better results. And how do you do it? Well, we've got all the tools available to us. For example, it involves Fibonacci, moving averages, the Kagi lines that we've seen. So let's look at this some more. Going back to my earlier hand-drawn gold example, so this time, instead of using a fixed target of $1,500, we're going to trail up the stop. So imagine that the horizontal lines of my drawings are Fibonacci lines, and as you move your stop to just below these levels, as the price makes its way further and further up, and to be finally taken out once that price reverts back through this moving stop. It's like you're stalking the price all the time. And like I said, there's many tools you can do to succeed in using the trading stop: pivots, Fibonacci, moving averages, parabolic SAR, Fibonacci trend line, support and resistance. So many. But what would that look like on our example? Well, here it is. You can see the initial analysis we did around the 900 level in that first example. We put our stop just below there, and then we had the target of 1500. But as we can see from this example, the price continued further. So with our initial stop under 900, once we got to the next price target of 1500, which was from the initial trade, we would then bring up the stop to under 1100, under that next line. And then as the price moves up to 1600, we bring it up to 1500, and then as it goes at 1600, 1700, again we bring it up to the 1600, and so on until you finally get taken out naturally. Now, all broker platforms that you use should allow you to adjust the stops like this, and it is a highly effective way of staying in a trade longer and eking out as much profit as you can from your trade idea. So another question I get often asked is, how much should I risk on a trade? And this is all around portfolio risk management and how it fits into your risk tolerances. I suggest risking between 1 and 5% on your trade. That gives you either 100 to 20 goes of being wrong. Statistically, you shouldn't really get 100 wrong in a row. But other methods you could use when getting more experienced: Kelly's criterion to size up winning strategies. But for now, I think you need to concentrate just on the fundamentals, and you've got to be consistent. So if you say you're going to risk 1%, then you stay with that 1%. You make it part of your trading plan. And the 1R that we talked about in the stop loss section will be the amount of risk you're allocating from your trade. So for example, if you have a trading pot of £10,000 and risking 1%, 1R has to be £100. So you fit that into your stop loss methodologies. All of these concepts work in exactly the same way, not just on Kagi but across almost all chart types. So we're building up tools that we can use elsewhere, and like I said, I'd like to emphasize the fact that I believe trade and risk management concepts are one of the fundamental pillars you're going to have to master to become a successful trader. They're often overlooked, and they shouldn't be. And remember that I said in an earlier section, you have to think like a casino owner and not the gambler. This is the case in point. You know, he's the guy that's the billionaire, and gamblers come and go, and he uses risk management, trade management to make money, and so should you. So in this section you've learnt how to enhance your Kagi charts, how to add indicators to these charts and therefore increasing the probabilities of success in your trading. You've learnt how to construct and enhance these Kagi charts further and the rules you need to follow. You've looked at some basics of building a trading strategy around those Kagi charts, and you also learnt how to apply essential risk and trade management rules to your trading of Kagi charts. We're now going to dive into section 4, which explores in more detail trading those Kagi charts. To kick off this section, we are going to look at two different strategies. First is a pure technical analysis multi-time frame approach on our friend the US S&P 500 stock index. The second we touched on briefly in an earlier section involving the Ichimoku chart, but it's a combination of different pure technical analysis indicators on a US stock. So let's dive into those two examples. Now this is an example of using multiple time frames to support your trading window. Now we've got the S&P 500 here. On the right we've got the 4-hour S&P chart, and we're just using a 10 ATR, which is giving us a $25 line reversal. And then on the left we've got a 1-hour S&P chart, again with the ATR 10 at 3.5 reversal. Now the rules are really simple. We start with the 4-hour chart and we just are looking for trend conditions. This is our trend filter, so we've got current black line in place here, so it's bullish. Our DMI that we've converted by removing the ADX. I've actually smoothed this out to 20 periods to make the trend more obvious, and that is also bullish. And if we highlight here, that line start there, that break actually covers all of the area on our left hand 1-hour chart. So any signal that we get in the 1 hour, we're only going to trade the bullish side. So now we know that we're bullish. We would come over, look obviously for new signals when they occur, but looking back historically, we would have ignored these red patches, the bearish trades, and we'd have looked to get in. We've got the awesome oscillator here. When the green comes after the red, and then our red Kagi lines that turn black, and they've broken this 10 moving average, we would get in the trade. Now we could again, like say, use Fibonacci on the 1 hour time frame to create our stop loss. So if we get in here, we might put our stop at 39.32. We could trail it up behind these lines as a trailing stop. That could be one approach. It could be a risk reward trade that you're playing, or it might be on the Kagi line coming back through the 10 moving average. I'll leave the exit decisions up to you, but I've thrown some examples. But the important factor here using this multi-time frame approach was to show you how to use a higher time frame, the weight and the importance of the higher time frames to the lower time frames. The higher you go, the more power they have over the lower ones, so you trade in the direction of the higher ones inside the lower one. That helps filter out a lot of bad trades. So there's one example for you on the S&P 500. So here we have Apple, the US tech consumer company, very popular for day traders. I flicked this to a longer term daily Kagi chart, and I fixed the reversal at 0.25, so quite aggressive. So that gives us quite a bit of noise on the Kagi chart, but all we have on here is the Ichimoku cloud, which you can see the red and the green, and the Bollinger Band set to 10.15 and a moving average of 10. And I've also drawn on some trend lines on there. So the first stage is to go to the Ichimoku cloud, and if the Kagi price action is above it, we're looking for bullish trades, and if it's below it, we're looking for bearish. So for most of this period, it's bullish. Our second trigger to get into a trade is when the Kagi line breaks through the Bollinger Band. So if it breaks through to the upside, it's a buy, and the downside it's a sell. It's not a sell if the price is still above the Kagi cloud, which we have some instances of. For example, around here and around there, we would ignore those. And I've also added on trend lines in various random places to show you how you can capture these breaks with a combination of rules. So here we've got the Kagi chart, Ichimoku showing bullish. It breaks through the Bollinger Bands, and it's broken through our trend line, and we get in. I'll put on the moving average there, as you could use that as a trailing stop to follow up your price and get taken out. Maybe here, yes, you're going to be giving back some trades, but maybe your rule gets you out when the line changes colour, or there's a risk return number that you've used and you're out before them. But as you can see, we've got various breaks throughout the up run that we could have taken advantage of. So again, another real simple strategy, again can work in different time frames, different markets, but here on a US stock, just to illustrate the power of putting combinations of indicators together and using it with the Kagi charts. And don't forget, also on there we can use a lot of the price chart patterns that we've looked at. Here we can see a double bottom. Have a look around, experiment yourselves, see what you can create. This is just another example for you. It's very important that we get the exit part right, so we're going to revisit some of the ideas we've already looked at, as well as introducing some new ones on firming up how to more successfully get out of a trade using Kagi. We are going to stick with our Apple example on the daily Kagi setup, and we're going to focus in on some obvious trades, and we're going to go through the 5 different exit approaches highlighted in the previous slide. So let's drill in on some trades, and first of all we're going to look at risk return. So we've got an obvious trade here. It's above the cloud, Ichimoku cloud. It's broken through the Bollinger Band. So now we're going to look at risk and return. So our actual entry point was here. This is a risk return tool in trading view, and we're looking for, depending on our strategy, we looked at examples of 2-for-1 risk return, less than 1-to-1 if we know that we've got a high win rate. But if we were to put, say, our stop under the cloud, very conservative, we've got a risk reward 0.5 to 1 if it gets up to this high, but the maximum there was a 1.19 to 1, which is a very good trade. But if you were running off a 1 to 1, you might set your target like that, leave this type of tool on your chart, and once you got to that point you would get out the trade. You could play around with this risk reward tool. You might have your stop under the Bollinger Bands here, and then this suddenly becomes a 4 to 1 trade, so very good. Or you could reduce the movement further, you still get a 2 for 1 just on that movement there. So that is the risk reward calculator. Secondly, we're going to look at Fibonacci. So we're going to find our Fibonacci lines. We're going to find the low and the high, and remember we're coming in here, so the high really is this point here, and the low, well, we have got lows here where it turned around, so let's pick that as our starting point. Let's drag those lines out, and what could we use? Well, we've come in here on this point, and our target could be this next Fibonacci line, which would have worked. We could put our stop behind each of these levels. We might be more conservative and start here and trail it up. We might want to be more aggressive and put it here, and then trail it up. So that is a brief look at Fibonacci. Now onto the Kagi lines themselves. So we've got in our trade here. Again, for our stop loss, we might look to recent turning lows, so we could have gone here, and that supports, under that Bollinger Band. We could have used the low here if we were being really aggressive. But where could we get out? Obviously, if you got the change of the trend from black to red, that could have been our get out. We could have used one of these patterns, one of these topping type patterns here to get out of. Remember the strength of the bars, the 50% lines we could use as potential targets. So the Kagi lines in themselves can be used as a risk management exit tool and stop loss tool. We could also use indicators like the Bollinger Band. We might get in here and wait until the price retraces back into the band and we get out. We might put another Bollinger Band on there with different setup, which might have a higher cloud shape here, and we get out higher. Let's just try that for example, see what we get. So here's a standard Bollinger Band I've just overlaid on there, and we might play around with the numbers. We might wait till it comes out and goes back in here, that sort of idea. Or like I say, play around with the settings with different offsets. You might introduce I don't know, 10 offset. Obviously that's giving you a weird number there, but you might reduce the time frame to shorter, 5 with the 10 offset, 5. It's all about playing around and seeing what works. And finally, you might use something like the moving average. So we've got in here and we trail up our stop loss, maybe at the end of every day or a period of time that you set, and we get taken out as the price breaks down through the moving average line. So 5 different ways of firming up your trade exit rules, but you must make them part of your trading plan. Don't pick 1 or 2 or 3 or variants of. You've got to be consistent. Make sure you stick with your plan, because you need to get the results to analyze, see whether your trades and strategies are working, and give you the best chance of making money from your trading strategy. Right, just recapping the rules that we need to deploy when running a strategy in Kagi. So first of all, don't just rely on that switch between the yin and yang lines. Add indicators, add chart patterns. It's all going to boost the probability of success. Remember that rule of collinearity, the crucial rule in technical analysis. Add together independent factors that confirm your decision making. Spend time creating the optimal Kagi line size. Don't backfit to make it work. That's very important, and that process should work across assets, should be as systematic and easy to put into practice as possible, and also essentially create the risk and trade management rules and make these part of the strategy, and again deploy these with a high level of consistency. And number 4 there, decide on the indicators you want to use. Trial and error. There are other indicators out there that I haven't gone through. Give them a go. They might work for you. Have a play around. Backtest your results either by eyeballing the data, downloading it, or if you've got the programming skills, analyze the data by coding it up. See if you've got that edge. If you can't backtest, then you've got to start from somewhere. So presume you've got a win-loss ratio of 50-50 and a risk-reward slightly in your favour at 51%, i.e. you've got an edge. Again, monitor those results as you go through. In a spreadsheet, say, look for any slippage. When you're creating your strategy, always ask the who, what, why, where, how, when questions. Initially, when you go live and you're still not sure, and instead of risking 1 R per trade, take that down to 0.5 until you're satisfied. You've gone through your testing phase and you want to scale back up to the 1 R level of risk. Now this diagram really highlights the whole process of trading, and it doesn't apply just to the Kagi charts, it's across all charts and trading strategies. You start with the research, and that could be technical, fundamental, behavioural. You find potential trades through your strategies, technical analysis, mental models. You then shortlist the trades, you put the orders in where you apply the risk and trade management rules, portfolio sizing, risk limit setting. You execute the trade. You then got to manage that trade through to exit using, like we said, the trade management rules, stops, etc, etc. We then want to get out of the trade, and we have a process around that. We then record our results, and we can do that in a spreadsheet, and in a second we'll look at some variables that you can use to measure that. We analyze, and then we go back to the start, and we're constantly trying to improve the trading process so we can get better and better returns. A lot of traders also just think when the trade's finished that's the job done, but actually the best traders are constantly analysing the performance, like a sportsman measures his performance to try and improve. The trader should do the same, and it's a big topic in itself, but there's some basic ratios you could look at, or information statistics, to ascertain whether you're doing okay or not. The win-loss ratio and the risk return we've talked about already as important. Sharp ratio is a very good measure of success and is used very much in the hedge fund world. Holding period, how long you're in the trades, whether you're long or short, your average win-loss, your average drawdown, biggest drawdown, number of trades. There are many more, but you can formalize all this in your trading plan and, like I say, make it part of your process, maybe weekly. You analyze what you've done, automate it out and have it as a constant variable into your trading approach. I have it automated, and I can work out trade sizing and risk management, trade management rules on the fly, because I feel that analysing and keeping on top of the data is crucial for your success. Finally, always have a trading plan. Treat your trading like you would running a business. You wouldn't go to a bank manager for a loan if you didn't have the stats to back it up. It's the same with trading. Don't trade it if you haven't got the edge to back up your ideas. So constantly evolve and learn from your trading plan. It's a work in progress, and it is a crucial part of the success of trading. It will help create discipline and consistency, and that's what you need. Now, you don't have to use these Kagi charts as your main trading weapon. You can use them as a supporting tool. You might be using Heikin-Ashi charts, candlestick charts, and you use the Kagi chart as a support and resistance tool, or a trend filter, or an exit tool. So let's take a look at an example how we could do that. It's a pretty similar example to our multi-time frame Kagi approach. Here we've got the GBP USD currency pair. On the left, 1 hour candlestick. On the right, 4 hour Kagi chart, 1080R setting. Now, again, we would start on the right hand side, use the Kagi as maybe the trend filter. Currently, it's gone from red to black. The indicator there suggests it's bullish, but if we look below the ATR, the orange is above the blue, so actually it's bearish. So in this instance, we might stay out because we've got a positive and a negative, and meaning more likely sort of an unsureness in the currency pair worth staying out of. Is a possible example, but if, for example, both married up to bullish, we would go over to our 1 hour candlestick chart, and we would use the rule set within that to then be bullish and looking for bullish opportunity. So it can be a trend filter. We could also flip, say if we were short and we then suddenly went to bullish, we might get out of a trade. It could be an exit tool for us. So again, it doesn't have to be the raw trade tool, the Kagi chart. It can support any type of chart type in any time frame in any market. So think of other ways of using Kagi, not just directly. Kagi lends itself very nicely to be automated in a systematic algorithmic process. Now, the future of trading is already starting to evolve, and that does involve actually a lot of the programming, coding, automation. We're seeing more and more of the flow in the marketplaces across all asset types turning to this way of trading, so it's becoming more and more important. So if you've got those skills, the world is your oyster. Favourite programming languages, especially in hedge funds at the moment, probably Python in the bank, C++, but you can use what you're comfortable with. I use Python and Ruby on Rails, and Python the current pick of the bunch. I've had success with both of those programming languages. What I found at the moment is that data is the hardest thing to get your hands on. It's either too expensive because you want real-time data, or unreliable. So getting hold of it is very tricky. So some ideas, go through a broker that offers APIs into their data. Use cheaper, more reliable services like QNL or Quantopian, I actually use a broker solution for my automated trading process. I trade through them, so they get some money back, but they allow me to API into their database, so I can pull back many years of history, high, low, open, close stuff that I know works for these Kagi charts, and on top of that I can pull other information that they also store. So again, this part of the trading world is getting bigger and bigger and something not to be ignored, and if you've got the skill set, definitely worth joining in. Now, this course wasn't built for going into the ins and outs of programming, but if there is the demand there in future, let me know in the feedback and I can put together more specific programming trading based courses. So in section 4, we've learned about building your own Kagi strategy, giving you a firm platform to develop a systematic, consistent trading process, incorporating risk and trade management processes as well. We've given you some alternative thoughts and ideas for your Kagi charts and how you could possibly start going about turning your strategy into an algorithmic trading process to take advantage of the changing environment and landscape of trading today. Well, hey, congratulations, you've now finished the course. I hope you found it beneficial, but before we finish off, we've got a few more final pieces to cover off. So let's summarise what we've learned on the course. You've now got a good grasp on Kagi. You can see how effective this sort of chart can be, giving you a trading edge. You've seen that it can work across all markets. You know what Kagi is and where it comes from and how it fits in today's modern world of trading. You also understand how to construct a Kagi chart and the mathematics behind how we calculate those lines. You know how to enhance those charts and put the odds more on your side, and you should now be able to construct a Kagi strategy, also applying the most crucial elements of risk management and trade management to that process, and understand that Kagi creates discipline and consistency in your trading, which, as we know, is crucial for trading success. And now you're ready to take all these learnings and apply them into the real world of trading. At the Stop Hunter, we're more than just a e-learning business. We help you find the right brokers, who I use in my trading, recommendations, what works best in certain countries, the markets you might want to trade, the products, like spot, FX, CFDs. We can help you with the charting, technical analysis packages, finding out more about what I use, again, recommendations and how you can sign up to the charts used in this course. And also we offer other services and trading solutions like our Traders Club, our managed account fund, my book on trading psychology, and other free resources, blogs, offers and much more. All you have to do is visit www.thestopHunter.co.uk, our website, to find out more. So what should I do next, you ask? Well, in the next few days, take a few days off and let it all sink in. Then over the next few weeks, develop and finalise a trading plan. Decide on your Kagi setup, the strategies, the objectives, set realistic goals and objectives, time available, how will it fit into your lifestyle, get those risk and trade management rules nailed, and the controls and processes put in place, and like I say, get that trading plan finished within that 2-week period. Then within the next month, if you haven't already, get those brokers finalised and your fund set up in your trading accounts, sort out the hardware, make sure you've got a decent computer and internet and workstation. Get the software sorted, the charts, any spreadsheets you need to build, or any other resources around your trading setup. And then all that's left to do is start trading. You're going to jump in sometime, and now is as good a time as any. Looking even further forward, commit to that trading plan. Keep track of your results in detail. Make that part of your trading plan. Use the resources highlighted at the stop hunter, and remember, trading is a journey. It takes time to be good at anything, and trading is no exception. So there's going to be frustrating periods, tough periods when you think, what am I doing? But it's a journey, and you've got to go through it to come out the other side, but it's well worth it. So to summarise, get as much experience as you can under your belt. Learn and keep learning. Maintain that passion for trading. Get a mentor. It doesn't have to be me. It could be someone on YouTube. It could be from a book. Continue with your professional trading development, and always seek help from the right people. Use those resources available to you, and speak and feed off like-minded people. And remember, trading shouldn't be a matter of life and death. So there you go, that's Kagi covered off very nicely and comprehensively. Now, if you want to get good at Kagi, you're going to have to put in the time and the effort in the charts. Take what I've given you here and apply it to your own world of trading and make it yours. Now, if you're new to my channel and you haven't subscribed yet, then please do. It all helps, but there's also a lot of extra content out there in the channel for you to use and utilize, along with this Kagi course and the other courses and other videos that I produce on a regular basis. Now, if you've got comments, feedback on the course, got questions, put them in the comments below, and I'll try my best to get back to you. Now, if you like today's video, please give us the thumbs up. Don't forget to subscribe and hit the bell buttons to receive future notification of other content that I'm going to produce, just like this. And all that is left for me now to say is thanks for watching, good luck with the trading, and I'll see you in the next video.